For today. Good morning, everyone. Happy Monday. Hopefully you had a good weekend. Today we're going to go over everyday broker call scenarios realtors can learn from. So these are just basically calls from everybody on the team that I get, throughout the year or month to month, or I like to track some of them because I think they're good learning experiences and good topics. Just as a small refresher on just little everyday kind of scenarios we hit in our transactions, and when you have a question, and then I give the outcome or the answer. Obviously, I don't share names or anything like that here, but it's good to kind of review them, and then we're also going to do or show you the parts of the RPA or whatever document it is that pertains to that particular question, so you can see where to reference it and what it says, just so we can all be, better at our jobs. So before we get started, though, we have Gary with Tried and True Home Loans. Good morning, Gary. How's it going?
I'm doing good. Thanks, Travis. Happy Monday. Let me
Happy
share
Monday.
let me share my screen so you can see the meeting of 3:13. Let me turn on the chat so I can see who's going to ask questions, if any. All right. Good morning, everyone, and thanks for joining us in the meeting. Just want to go over a couple of things right now before I hit the rates. One thing is the jobless rate. The jobless numbers came out a week or so back, and in February we had we lost 92,000 jobs in the market, and then they revised January and December down as well by quite a bit of job losses. So the Fed, they look at this and they see that the market's slowing. So what they do is they lower rates to try and make capital cheaper so people can invest in the economy and get the economy going. So the jobless numbers help rates. But then on the other side of the equation, you must know now what's going on in the world. And stopping by the gas station is quite painful right now because of the gas prices being so high, and the cost of oil is so high right now. And so this makes planes, ships, trains, trucks, cars, all the things that bring goods from the manufacturing or from the produce to the stores or to your home, it makes it all much more expensive. So they have to pass those costs on to the consumer. So now on the other side, we've got inflationary pressures. And so what the Fed does with inflationary pressures is they raise the rates to try and slow the economy down. So we've got on one side the jobless numbers and pressure to lower rates, and then on the other side we've got inflationary pressures and they want to raise rates. So where does that put us in mortgage rates this morning? Well, unfortunately, I don't have good news. The 12-month conventional right now is at 6.41. Last time I was on about 3 weeks ago, it was at 6.04. It did hit on February 27th. It did get into the magical fives, albeit it was at 5.99%, but we were always trying to get into the fives. Anyway, with recent news and the economy and all that good stuff, rates have gone up quite a bit, 0.4% almost. So this is the 30-year conventional. By the way, I was using Notebook LM. I thought, well, let's see what they do. So I've got all new slides throughout the presentation. So I'm not sure yet if I like it or not. I'll probably make some changes to it going forward, but this is the new slide as it is right now. So on the FHA, we're at 5.87. 27th of February, it was at 5.62. So again, quite a hit on the FHA. VA always follows, 5.89. 15-year fixed took a really big hit. 6.01 now. I forget what it was on the 27th, but jumbo, not too bad. I mean, 6.6 versus 6.4 for the 30-year conventional, so only 0.2 of a point higher. All rates took a hit. So this is where at right now we are slightly up. So if you're looking at the whole market, and you see here stable rates, and you go, hey, Gary, you just were saying that rates are up. And I'll show you in a second that even though rates are up, they are still relatively stable. But the issue that we're looking at is an inventory problem. And the inventory problem is caused by two factors. One is, like I've said in the past, homeowners are stuck in a very low rate. So if they're, excuse me, if they're in a 2.75 rate and they're going to go up to a 6.4, then, sorry about this, let me just get some water. Then the jump in the cost is substantial. So with stable rates, I just took the last 5 years, and if you look back at December 21, we were at around 3, up to June of 22, it went up to 7. Actually, no, it went up to 6 in June of 22. But sorry, my voice is going here. The over the past 5 years, we've seen these big spikes quite often, going up, and then they'll come down, they'll go up, they'll come down. Over the past 12 months, since January of last year, we've pretty much been in the 6 to 7 range. You'll see the spike that we've just had. If you look at the last 5 years, the spike right now it's not great, but it's not that bad either. So hopefully it's just a short-term measure, and when the oil gets flowing again, or they can get the tankers out of the Middle East, inflation pressures will come down and rates will follow. Fingers crossed. All right, so if we're looking at the three buyer objections right now, the three main ones at least. One is the rate objection. So buyers are saying, I'm waiting for rates to go down, and in reality, demand and competition spike when rates drop. So it's not usually a good idea to wait for rates to go down. If you remember back in 2020 and 21, when rates were down, competition was crazy. Prices were through the roof, and most listings sold for much, much higher than the listing price. So the talking point, or you can mention to your buyers if they have this objection, is they can refinance later. But if they're going to wait and say buy in 12 months, more than likely prices are going to be up. If rates are down at that point, demand is going to be up, prices are going to be up. And so they will not be financially better off waiting for rates to go down. If they can, it's better to buy now, refi later. So another objection is I'm waiting for prices to drop, and in reality, the supply shortage prevents a market crash. I'm going to talk about supply in a second, but in reality, prices are flattening, they're not crashing, and no one is expecting them to crash. I mean, you see in some of the media, the clickbait stories where, they're trying to scare people and say that there's going to be a crash. No one is saying that in truth that there'll be a crash. Most of the homeowners they've got good mortgages with good rates. They can afford their mortgages, not like in 2006 where we had extenuating circumstances like the adjustable rate mortgages, which were adjusting and causing people to not afford their new rate. We aren't seeing that now. And then the inventory objection, I want more inventory. And again, part of the problem is the sellers are trapped in low mortgages. But the other problem also is that sellers are stuck because there's no houses to buy. So if they were to sell their house, they wouldn't be able to find a suitable replacement. So they're kind of stuck. It's like being stuck on the freeway. You always need someone in front of you to get going so that the rest of the traffic can start moving. And at the moment, with the rates being what they are and sellers not being able to find a replacement property, the inventory is kind of an issue. And the talking point, more inventory also doesn't mean less competition quite often. It just means that more buyers come on the market. And then just like with the rates and the price drop, there's more buyers on the market and competition is strong. So the root cause of the housing supply problem, we need about 1.8 million construction. This is the Census Bureau is saying that we need 1.8 million units built each year. Currently, it's around 1.3 to 1.4 being built. So we're about 0.4 to 0.5 million, half a million homes shy every year. And that's taking into account that at the moment, nationwide, we have about 5.5 million homes shortage, and that's by the NAR numbers. So we're not just short on homes, we're adding to the shortage every year. So thankfully, Washington has responded. This is the 21st Century Road to Housing Act, and this just came out this year. And last week, it was, I think, Thursday, it went through the Senate, and it passed the Senate 89 to 10. So the bill basically includes 40 provisions to cut the red tape, encourage construction, and improve affordability. So after this, it's got to go to Congress. And Congress have said already that they'll probably do some amendments to it, but more than likely it will get passed. And then it's got to go to the White House to get signed into law. The reality check, though, is this is going to take months to get it into law, but then builders are going to have to respond to this. And it takes time for builders, especially at this scale, to start to build enough homes to make a difference in the market. So this is not going to be a short-term fix, certainly not this year, but hopefully in the next year to 2 to 3 years, we will start to see a trickle of improvements with supply, especially on the new construction. So hopefully this comes through. So this is so far it seems like all I've had for you is bad news with the rates and all this nasty stuff. But I do have some good news. I was talking to you last year about the Home Buyers Privacy Protection Act that went through the Senate and Congress last summer, got signed into law last September. So why am I talking about it now? Well, it just came into effect March 5th. So this is good news. I think I mentioned last time what trigger leads are. It's basically if you do a hard pull on the credit, then the credit bureaus can sell the consumer's information to whoever basically wants to buy it. And so the buyers or the borrowers would get bombarded with calls and spam messages and all kinds of stuff. So that so that's basically stopped. There are a few caveats in that the current lender that the borrower has can still call them, and any financial institution that the borrower has a relationship with, they can also contact them. Now, normally with banks like with Chase, Bank of America, Wells Fargo, or credit card companies like, say, Capital One, it's not part of their business model to call trigger leads. So it's highly unlikely that if your borrower or buyer has a relationship with Chase or B of A or Capital One or whoever, they aren't going to be calling them. But if they do have a mortgage with, say, Loan Depot or Mr. Cooper or someone of that nature, it's still possible that they'll get calls. So I would still say use the optoutprescreen.com website just to make sure that the borrower is protected fully on this one. But it's a good thing that it's come out. So things are definitely better. So we're at no. So yeah, so the closing thoughts are if you step back and look at the market right now, buyers are waiting for lower rates, lower prices, more and more of the inventory. But the reality is we're still dealing with a 5.5 million home shortage, and even Congress is getting involved now. So the real question the buyer should ask isn't, is this the perfect market? Because more often than not, it isn't. There's always something that can put a spanner in the works if you let it. But a better question that they could be asking is, if the right home came on the market tomorrow, would I be ready? And the buyers who win are the buyers who are pre-approved, prepared, and ready to take advantage of the opportunity. So that's where you and I come in. It's up to us to make sure that the buyers are pre-approved, prepared, and ready. So with these meetings, it kind of gives you some information that you can talk. So if the buyers do have objections, you can go to them and say, if the rates, if they're waiting for rates to go down, you can mention now the pros and cons of that decision. So if you do need me to help you on this, or if you do have buyers who need to get pre-approved, um, my contact information is still there. It's changed. It's a bit smaller than it was, but my contact information is there. And then if you want to scan the QR code at the right, you can save my details to your phone, and I would be happy to help in whatever way you need. So that's basically my thing. And let me see if I can stop the share and go back to Travis.
All right. Good info there. Yeah, unfortunately, we saw rates tick up all week last week, real quick. So that wasn't real fun to watch. Hopefully, if you have anything in escrow, your buyers were locked the previous week or the week before that. Because last week did get out of control a little bit. We'll see how this week goes. Hopefully, kind of settles down a little bit, but we'll find out next week, I guess, on the meeting. So thanks for that info. I'm going to go ahead and share my screen. All right. So broker call scenarios. So what I like to do a couple times a year is, I kind of store up some of the calls that, the team brings to me on a daily basis and use them as a teaching moment, um, just so we can all be better at our jobs and know how to handle situations a little bit better. So if you have any questions along the way, um, oh, is the chat disabled? Hold on one sec. I thought I disabled, or I thought I enabled it. Someone just posted in there. Sure is. Okay. Chat is now enabled. Sorry about that. So we'll go ahead and run through these topics. I like doing these webinars. Some of these um, are a little bit older scenarios because I think they're relevant, and we do have a lot of new team coming on all the time, and they're good refreshers. But I have plenty of new ones in here as well, as new as about 2 days ago. So let's see what we got here. So first up, and again, if you have any questions, go ahead and throw it in the chat. If you want to discuss things, we could do that. I can also unmute you if you want to raise your hand. So this one was a newer one. So I used an outside agent to show a property to my client with an understanding of a fee being paid for the showing. The agent poached my clients and bought a different house. Do I have a case for compensation? So this depends on whether or not you have an exclusive BRBC in place or a written agreement in place with the showing agent. If you have a non-exclusive BRBC in place with your buyer, there must be broker involvement in quotes in order to have a case for procuring cause. Now, the BRBC and the PSRA, the two compensation documents you can use with your buyers, both are defaulted to non-exclusive. You have to check a box to make it exclusive. So be sure you're looking at that and discussing that with your clients. So the BRBC form contains a default non-exclusive representation provision, which provides for payment of compensation to the broker only if there was sufficient broker involvement with the property. What is broker involvement? So they actually have this defined in the BRBC. So we're looking right here at the BRBC. This is the first section below the grid section where you fill out all the sections there. Broker involvement, wherever used in this agreement, means any of the following. Buyer physically entered and was shown the property by broker. Broker showed the property to buyer virtually. Broker submitted to seller a signed written offer from buyer to acquire, lease, exchange, or obtain an option on the property. Broker performed a market analysis related to the property or viewed property specific documents or disclosures with the buyer, or the property was introduced to the buyer by broker for which the broker acted on behalf of the buyer. However, merely sending a buyer a list of properties shall not be deemed broker involvement without documentation action on the part of the broker analyzing the property for the buyer, specifically, or assisting buyer in the potential acquisition of the property, or communicating with the seller or seller's agent regarding buyer's potential acquisition. So just having them on a email drip from MLS or your CRM of new properties coming on market does not suffice the broker involvement provision here. So you have to actually do some work in order to be procuring cause there. So in this instance, agent had a non-exclusive. The agent found out later that the buyers, the agent found out through a Facebook post actually that the buyers had bought a new home. And it was not a home that our agent had done work on, broker involvement. So the question came up, do I have a case for commission here? And in my opinion, the answer is no, because there was no broker involvement on the property that those buyers actually bought. Uh, there was only broker involvement on the property uh, that was shown by the showing agent that was set up with our agent. So you want to make sure that for one, you're keeping your clients, in contact, and two, um, that you have either an exclusive in place or maybe even a referral agreement or some sort of commission sharing agreement in place with a showing agent in that instance. So if you're going to be working with someone out of the area, um, make sure you have something in writing with them stating that this, our agreement for, commission sharing or for me to pay you for opening doors, essentially, make sure that stuff's in writing. So, yeah, that was kind of an unfortunate one. Um, yes, it could be an ethical issue. Yes, it is. Was the other agent unethical? Yeah, I believe so, 100%. Are they in their right to earn the compensation? Actually, they are because they put the BRBC in place with that client and sold them a different house for which our agent had no broker involvement with. So to get compensated based on the provisions of the BRBC and the RPA and AB 2992 and all that fun stuff, I don't believe there's a case there whatsoever. Um, Seller sent a counter offer to buyer number one. A new offer came in, we'll call that buyer number two, after sending buyer one a counter offer that the seller wanted to work with. The listing agent sent a withdrawal of SCO to buyer number one and accepted buyer number two's offer. So hopefully I explained that one right. So buyer's agent for buyer number one notified the listing agent that they had already signed the counteroffer, but the buyer's agent just hadn't sent it back yet to the listing agent, and too bad, they have a deal. So, what do you think? Do they actually have a deal here? Let me check chat real quick. All right, so um, let's see if anybody throws any answers here. Yep, so that is correct, Leo. Needs to be delivered. So they did not deliver it. And if you look here in the counteroffer, we're in section 2 here, and it says this seller counteroffer shall be deemed revoked, and the deposits, if any, shall be returned unless by 5 p.m. of the third day after the date of this counteroffer is signed. Um, Either it is signed in paragraph 5 by the buyer, and a copy of the signed seller counteroffer is delivered to the seller or seller's agent, authorized agent. So, although they signed it, they have not sent it back. So, therefore, there was no deal. The seller signed the agreement with buyer number two, and they had not even received the signed seller counter back yet. So the date doesn't necessarily matter, it's when it's delivered. So you got to keep that in mind that if, you know, the seller can accept something at any time if they don't have something back in writing with an acceptance. So that kind of brings us to the next one. Seller sent us a counter offer, but then accepted another offer without notifying us before we responded. Can they do that? So at any time during the offer or counter offer stage, the seller can accept a competing offer without notice. We have to always keep in mind that time is of the essence. We've all heard that many, many times. So if we look right here, number 2 um, says um, or if seller accepts offer prior to buyer's acceptance of this counter offer. So if you have just a seller counter offer out and some other buyer comes in and you want to work with them, you can, you know, should you notify the other party that you have another offer in? You probably should. I mean, this can lead to other little complications, but yes, it is totally legal. You can just sign that other offer. Maybe a cash offer comes in, looks great. You just want to accept it right then and there. You can, even though this other counter offer had been sent out. You should probably withdraw that other counter offer though, just to avoid confrontation, I guess, if you want to call it that. Marketing to other buyers, you will see number 3 right here. Seller has a right to continue to offer the property for sale. Seller has a right to accept any other offer received prior to acceptance of this counteroffer by buyer as stated in 2A and 5. In such event, seller is advised to withdraw the seller counter before accepting another offer. Saying advised isn't a law. It is not a law. But again, if you want to avoid some, confrontations and things like that, or potential complications, I would recommend doing that. But yes, this happens more often than you think. So we just got to keep in mind all the time that time is of the essence while you're negotiating out your deals. Let me open up this Q&A too. Okay. So, all right, next one. Listing agent, seller let her offer expire and did not respond. What can I do? So paragraph 33 of the RPA states, seller has no obligation to respond to an offer made. We're looking at it right here. It's in bold even. The expiration date time of an offer or counteroffer only relates to the amount of time the offer or counteroffer is in effect. So an example, if a buyer makes an offer on a property and the seller does not respond prior to the expiration date, then after the expiration date, the buyer would no longer be obligated to the terms of that offer and could offer on additional properties without concern. Even if the seller responded with an acceptance after the expiration date, the buyer would not be obligated to move forward. Same goes for counters. And in the most recent revisions of the RPA and the counters, they put in a late acceptance where then the seller would once again, or the buyer would once again, have to sign stating that they agree to move forward with the late acceptance of the other party, meaning it was past the expiration date. Now, if you suspect that the offer was not presented, here are some things you can do. Document the date, time, and method used to deliver the offer to the listing agent and any follow-up efforts on the status of the offer. Consider contacting the broker of the listing agent. Consider sending the listing agent one of CAR's sample letters. Demand that offer be presented to seller. Request to participate in the presentation of an offer, or request for the listing broker's written confirmation that the offer has been presented. The sample letters are in the CAR Forms library. If you are in the little search bar there, you can toggle up to all, and you will see those forms in there. Which brings us to the question, can you legally deliver the offer directly to the seller? NAR Code of Ethics, Standards of Practice 1613 states that dealings with a seller who is subject to an exclusive agreement must be carried on with the seller's agent or broker, except with consent of the agent or when initiated by the seller. However, Model MLS Rules 9.1 allows for direct negotiations if after reasonable effort and no less than 1 day, the buyer's broker cannot contact the listing broker. But the listing broker may preclude such direct negotiation by giving notice through the MLS. So contact your own MLS for details regarding Rule 9.1. Buyer investigation contingency removal for review of seller disclosures is due today. The listing agent is pressuring us to remove the contingency, but they have not delivered all seller disclosures. Must I remove the contingency? How do you guys feel about that one? So if we look at paragraph 14 of the RPA, we're in 14.3 right here, says buyer is advised not to remove contingencies related to review of documents till after the documents have been delivered. If delivery of any reports occurs after a contractual contingency pertaining to that report has already been waived or removed, the delivery of the report does not revive the contingency, but there may be a right to terminate for subsequent amended disclosure under paragraph 11. So even the RPA is advising not to remove the contingencies until seller has fully performed. So should the buyer remove contingencies while the seller fully performing their obligations to deliver all disclosures and documents, they will be acting against the advice of the broker. So I definitely would not advise on it. The buyer agent shall get documentation in writing stating we are not advising they remove the contingency. So in this instance, yeah, could they do it? Yes, they could. We as buyer's agents should not be pressured by the other side. We need to make sure that we are performing our fiduciary duty with our buyers, and making sure the other side has fully performed before we can advise on them removing contingencies. Now, the buyer can do whatever they want, but we're going to want to get it in writing that they were advised not to do so until the seller had fully performed. The RPA paragraph 14F also notifies the buyer. So here's effect of removal of contingencies. Removal of buyer, if buyer removes any contingency or cancellation rights, unless otherwise agreed, buyer shall conclusively be deemed to have completed all buyer investigations and review of reports and other applicable information and disclosures pertaining to that contingency or cancellation right, and elected to proceed with the transaction and assumed all liability, responsibility, and expense for the non-delivery of any reports, disclosures, or information outside of the seller's control and for any repairs or corrections pertaining to that contingency or cancellation right, or for the inability to obtain financing. So um, it's it's pretty clear in two sections of the contract not to remove contingencies until the buyer is fully satisfied and the seller has fully performed. So question came into chat. What if buyer's contingency date has expired and the seller has performed? Buyer's lender just hadn't given the buyer prior or final loan approval. So what if the buyer's contingency date has expired and the seller has performed? Buyer's lender just hadn't given the buyer final loan approval. So the seller would need to send a notice to perform for one thing. The contingency stays in place until it's removed. So even if it's expired, that doesn't mean that it's gone. So the contingency would still remain in place in this instance right here until either the seller sends a notice to perform or the buyer removes it. We see it quite often, and it's actually not in alignment with the contract, but where maybe a loan contingency or other contingency remains intact, as in the buyer did not remove the contingency fully or with the contingency release form. I've seen them run all the way to close of escrow where, we have close of escrow happen and only some or maybe even none of the contingencies have been removed. Um, that's really poor representation on the listing agent side, in my opinion. Also on the buyer side, you are not following the contract, but it would have left the buyer with a right to cancel technically up until close of escrow. All right, so next up, the home inspection is complete and a $2,000 credit for repairs has been agreed to by the seller, but only if we sign by 5 p.m. today. The seller has not sent the NHD report, listing site avid, as well as some other disclosures. The listing agent is pressuring us to sign a CR1 that looks like this. So if you look at the screen, they sent over the signed request for repairs, which was partially modified to provide a credit for the 2000, and they attached this CR to it, stating that they want the entire buyer's investigation contingency removed. So the agent stated, my buyer wants the 2000 credit and time is running out. Can I have the buyer sign this CR1? And if there is something negative on the ANHD or the listing site avid, can we use another excuse to back out? And the answer is no, because the buyer would not be canceling in good faith, and only the appraisal and loan contingency would be left in place to cancel with. So there's really not much, meat on the bone to cancel with, and it wouldn't be in good faith anyways. So now, if they hadn't sent over the NHD and you had already released the contingencies, we get into kind of a sticky scenario there. But my advice in this particular scenario was to notify the listing agent that we cannot advise the buyer to sign this CR as all the seller disclosures have not been sent to us. They haven't been delivered. The seller is pressuring the buyer to perform on a contingency release on an obligation of the seller that they have not yet performed on. So the correct CR that the buyer can safely sign should look something like this, which is the one that is stated in the request for repairs. And that is only the part of the investigation related to the inspections concerning physical attributes of the property. So that's the one that I would be comfortable with my buyer signing, which would still leave the document review contingency in place in this scenario. Now, could the buyer have signed, because they really wanted this $2,000 credit? Yes, they could have signed, but we would have had, I would advise something in writing stating, look, you're going against the advice of the broker, just like on this previous scenario. You're releasing contingencies for which the seller hasn't performed on yet. So we're recommending you don't. Next up, let me look and check Q&A. No. And check chat real quick. All right, I think I got those. So buyer is not making any repair requests. Do I still fill out the RR? In my opinion, it's good practice to have a record of the buyer making no request for repairs or credits. Simply type into section 1 of the RR, this verbiage or similar. So we're looking at the RR, buyer request, check the box. Buyer makes no request for repairs, credits, or price adjustments. So this is creating, basically a paper trail. It's protecting everyone, really. This will create a more formal paper trail with the buyer that they did not make a request, and they're signing it. Additionally, there is a release in 4B of the RR that is a good addition to your transactional risk management practices. So if you look in section 4B, it says buyer releases seller from any loss, liability, expense claim, or cause of action regarding the disclosed condition of the property. And I'm sure we would all really like that on file. Next up, my buyer made a request for repairs, but the seller is not responding. What do I do? It's good practice for a listing agent to have the seller formally rejecting a request for repairs, car form RR, that they are not willing to entertain. However, just as a seller is not legally required to respond to an offer, the seller also has no requirement to respond to a request for repairs or amendment. That's why they call it a request. So if we look here in 14B 2, it says seller has no obligation to agree to or to respond to buyer's requests, form R, or the 4R. If seller does not agree or does not respond, buyer is not contractually entitled to have the repairs or other requests made and may cancel based on contingencies in this agreement. On top of that, I'll just read the rest actually. In this case, the buyer is still required to perform on the contract regarding the timelines to remove contingencies, and the seller may choose to send a notice to perform. Should the buyer not remove the applicable contingencies, seller may cancel per the terms of the notice to perform. The request for repairs does not extend the investigation's timeline per the terms of the RPA in any way. So if you send your RR, whatever, a couple days before the investigation's contingency is due, and the seller's not responding, now you're past the date, your contingency is not being extended. That's not how it works. Technically, the buyer should be releasing that contingency, or the seller can simply send a notice to perform and not even respond to the 4R or the RR. So buyer must choose to exercise the right to cancel based on adverse findings from investigations or proceed with the purchase of the home and release their investigations contingency. That's really their choices at that time. Let's see, next up, seller has an SIP in place. When does the timeline start? Close of escrow is day 0. The next day is day 1. And this is stated here in section I, or paragraph I. Number 6 here, COE is considered day 0 for purpose of counting days. Seller is allowed to remain in possession if permitted by the agreement. Next one, close of escrow date has passed, and now the buyer wants to cancel. Can we keep their EMD? My first question back to the agent asking this question is always, are all of the contingencies released? If they are released, then yes, the seller could be entitled to the EMD. If there are contingencies in place, the buyer may have a legal way to cancel, even if they are past the close of escrow date. So it's your responsibility and duty to your client as a listing agent to make sure the buyer is performing on all aspects of the contract, and also make sure that the seller has performed as well, because that can also create a legal challenge if the seller has not performed and now you are past the close of escrow date. So Contingencies must be physically removed no sooner than the date of performance in the contract. So always use CAR Form CR to do this. Um, Chip away at contingency releases throughout the escrow period according to the contract timelines. Use notice to perform when necessary. If buyers are refusing to release contingencies per the timelines and the seller has fully performed, deliver notices to perform to maintain leverage. So I wouldn't be shy with sending out the notice to performs when you're on the listing side because that is just good fiduciary duty. Even if things are going well, you can send that form out 2 days prior to the date of performance by the buyer, no sooner than that. But you could, which would give the seller a way to cancel on the day of performance because you will have already delivered the notice to perform. This is in the RPA. It's actually good. It's just good fiduciary duty because you are representing your client to the fullest and making the buyer perform and putting your seller in a position that they can cancel as soon as possible, really, if they wanted to. So if a buyer needs an extension of time, I always say get something in exchange, either partial or full earnest money release to the seller or a per diem charge agreed to, or even both. I personally prefer the EMD release. This way, if the buyer ends up defaulting or canceling later in the escrow period, the EMD has already been released and there is little or no monetary dispute to resolve. If the buyer is already tight on funds to close, the per diem charge can sometimes cause a bigger issue at closing. So that's why I always prefer the EMD release instead, or at least partial. And that always tends to make my seller clients happy. Always keep your seller in a leverage position by having contingencies released according to the contract. The seller doesn't have to cancel if a notice to buyer to perform has been delivered and the time has seasoned. It just puts them in a position to act swiftly, though, if needed, if these buyers keep kind of playing games. All right, on to some FHA stuff. So the appraiser conditioned for all repairs, for repairs on a FHA appraisal. Who pays for the repairs? What happens if the seller refuses to make repairs? So paragraph 5C4 pertains to FHA and VA offers, and it says if FHA or VA is checked in paragraph 3E1, and that's the first page of the RPA, the grid section, a FHA VA mandatory clause, form FVAC, shall be incorporated and signed by all parties. Buyer shall, within the time specified in 3E1, deliver to seller written notice on an amendment or with your RR of any lender requirements that the buyer requests the seller to pay for or otherwise correct, or that there are no lender requirements, notwithstanding seller's agreement that the buyer may obtain FHA or VA financing. Seller has no obligation to pay or satisfy any or all lender requirements unless agreed in writing. I probably should put this in here. We had a scenario like that where um, the buyer was advised to uh, pay for repairs that came back on the VA purchase because this was a short sale property. And, in a short sale, the seller allegedly has no funds, right? Or not enough funds. So what ended up happening is um, the sale ended up canceling because a lien popped up on title after the short sale approval, and it was a pretty hefty lien, and it couldn't get cleared. So now that short sale could not be performed, at least not on any, short timeline. It's going to take a while to resolve this. And now the buyer is out the appraisal and the home inspection and the repairs they made to the property. in order to satisfy the appraisal conditions for VA financing. So don't let your buyers get in that position. There's a little tangent here. I do not recommend, I guess this is, based off of our webinar a few weeks back about REOs and short sales. I don't advise FHA and VA buyers to purchase short sale homes because these are the types of things that can happen. Um, so, all right, back to this. You can see from this section that it states buyer shall, within the time specified, deliver to seller the RR or amendment of any lender requirements that the buyer requests seller to pay. So here is the snippet from that page one there. So in this instance, it's saying 17 days by default. We will deliver a list of lender required repairs. But again, there is no obligation for the seller to pay for or correct any lender appraisal requirements for the home to qualify for FHA VA financing. They are merely agreeing that the buyer may use FHA or VA financing. So if you have a concern that the seller may not agree to correct lender appraisal requirements, then you should be addressing this in the original offer or counter offer. This will bind the seller to making these corrections if required. And you can use section G2 of the grid section of the RPA. Says additional seller credit terms does not include. So it says seller agrees to correct at seller's expense any lender or appraisal conditions required by FHA loan funding. You can use an amendment, you can use several things, but you probably want to put something in there binding the seller if you can to making these corrections so that we don't get into these sticky points in the transaction where the appraiser conditions the appraisal on some repairs that need to be done. And all of a sudden the seller is saying, well, I don't want to do that. I said you can use the financing, but I don't want to make any repairs. So next up, the home did not appraise and the buyer is canceling. The listing agent asked for a copy of the appraisal. Do I have to provide it? So the answer is yes. If the buyer is exercising their right to cancel based on the appraisal contingency, then they must provide a copy of the appraisal upon request. So 8B1 of the RPA states this. And that right there is the appraisal contingency. Says for any cancellation based upon this appraisal contingency, buyer shall deliver a copy of the written appraisal to seller upon request. Next up, I've had this question come up a couple times, and I've also seen other um, it's not always on our side. Sometimes it's on, the other side. And you, as a listing agent, you got to kind of sniff this out a little bit. So the home did not appraise, and we waived the appraisal contingency up front. Can the buyer use the loan contingency to cancel since they won't have enough money to close escrow now? Section 8B2 of the RPA covers this scenario, and the answer is no. If a buyer is wanting to waive the appraisal up front with thoughts that they can use the loan contingency to cancel, just refer them to this section of the RPA. So we're looking at B2 here, no appraisal contingency. If no appraisal contingency is checked in paragraph 3L2, the buyer may not use a loan contingency specified in paragraph 3L1 to cancel this agreement if the sole reason for obtaining the loan is that the appraisal relied upon by the buyer's lender values the property at an amount less than specified in 3L2, which is the purchase price. If buyer is unable to obtain the loan specified solely for this reason, seller may be entitled to buyer's deposit or other legal remedies. So don't try and sneak that one through because it's right there in the contract. We do have a question on that. The seller offers to make up the deficiency of the appraisal. Can the buyer still cancel? Technically, I don't see why not. I mean, if they don't want to buy an undervalued house, yes, but the seller's not really making up the difference. They would be lowering the price to the appraised value. So maybe that's what you were referencing. And in that case, I think that could probably be challenged because it would be renegotiated down to a new purchase price of the appraised value. So, yeah, we waived our appraisal contingency, but not our investigations contingency. Can we use the investigations contingency to cancel if the home does not appraise? And again, I advise using this tactic. This is the one I see come across sometimes, especially in a really competitive market, where there's multiple offers and the buyer's like, well, hey, I'll waive the appraisal contingency. We just want this place. And then you'll notice that they get the investigation, the home inspection, like the next day or, a couple days later. So this is the one that you really got to sniff out as the listing agent. Um, I advise against this tactic as EMD can be disputed by the listing or agent or the seller. The reason is due to paragraph 14 of the RPA. Clearly and boldly states that a cancellation based on contingencies must be exercised in good faith, in bold. So using the investigations contingency to cancel based on a low appraisal would not be canceling in good faith, and you may end up with an EMD dispute. Additionally, if you advised your buyer to do this and told them they can get their earnest money back because you would just use the investigation contingency to back out, could land you in hot water with their client as well if they get caught up in an EMD dispute. Contingencies are not interchangeable with one another. So you can see in bold, the whole first paragraph of paragraph 14 is in bold. So it says the following time periods may only be extended, altered, modified, or changed by mutual written consent, agreement. Any removal of contingencies or cancellation under this paragraph by either buyer or seller must be exercised in good faith and in writing. So very important that we are advising our clients correctly. I would never guarantee EMD to be, returned, even though they might have a right for it to be returned. I would never guarantee that because it takes two signatures, buyer and seller, to release that earnest money. So just because contractually the buyer is entitled to it back doesn't mean the seller is in agreement with that, and they may try and challenge it. They may be misinformed, whatever it might be. We still need their signature. So I usually say yes, you would be entitled to it back. I don't guarantee it back. The buyer did not remove their contingencies after we provided them with a notice to perform. Can we cancel the sale and retain their earnest money? Per 14C of the RPA, the answer is most likely no. 14C1 of the RPA clearly states that should the seller cancel the sale after first delivering a notice to buyer to perform, they shall authorize the return of the buyer's EMD. This also applies to contract obligations such as a buyer not providing updated lender contact, delivery of FHA VA costs or terms, delivery of pre-approval letter or proof of funds, return of statutory and or other disclosures, or any other contractual obligation stated in 14C. And you can see in 14C1, seller right to cancel, buyer contingencies. Last line, in such event, seller shall authorize the return of buyer's deposit, except for fees incurred by the buyer. Same thing in 14C2. Last paragraph, again, this is seller right to cancel, buyer contract obligation. So whether it's an obligation contractually or a contingency, either way, seller shall authorize the return of the buyer's deposit, except fees incurred by the buyer and other expenses already paid by escrow. So are there, scenarios out there where maybe the seller would be or could challenge that? Yes, there always is, but it's a very slim chance. So yes, it states right in here that if the seller's canceling, After sending the notice to perform, they do need to return the EMD. Question came in, can the seller withhold the EMD until buyer accepts cancellation of escrow? Well, so you have to remember that the cancellation form is two parts. Part one is who is canceling and for what reason, and that is canceling the contract. Uh, that takes one signature, the party that is canceling. So that is canceling the contract. Escrow is still open though. And that is part two. Escrow is still open because there's earnest money sitting in escrow. And both parties need to sign off on that to be released. So it's not that the buyer isn't accepting the cancellation. The EMD is just going to sit in escrow because escrow is not going to release that earnest money until they have both signatures. So yeah, then you get into a dispute status essentially, and sometimes that leads to a mediation or something. My buyer wants to make a non-contingent offer. Is this risky? Yes, always risky. Any market, any location. I don't recommend doing that. The buyer may be at risk for losing their deposit or paying other damages if the buyer decides not to purchase after the offer is accepted because there may be no contractual right to cancel the contract, even if the buyer decides to cancel before they deposit the earnest money. That's a misconception as well. So this risk needs to be carefully balanced against the risk of having an offer with contingencies rejected. You'll want to use Form NCOA for all waived contingencies. I'm not saying waiving all contingencies, I'm saying any contingencies the buyer is wanting to waive. So you're going to include that in, and that is an advisory stating that we don't advise you doing this. So does the buyer have any rights to cancel a contract written without any contingencies? And technically, yes. TDS law states that if the buyer has provided a real estate transfer disclosure statement, your TDS, after the buyer submits the offer, or the TDS is updated or modified during the transaction, there is a statutory right to cancel the offer within 5 days after delivery of the TDS or updated TDS by deposit in mail or email, or 3 days if they deliver it in person, which probably isn't happening. You will get pushback on this if you're submitting an offer with investigations contingencies waived, and it may cause your buyer's EMD to remain unreleased in escrow in a dispute status. Any contingencies waived up front in the RPA will require a second advisory called Form NCOA to be signed by the buyer for the transaction file as risk management for both you and the company. So I don't want to call that a loophole. That's just TDS law. So, if the TDS is delivered prior to the offer, then yes, that would be, if you are a listing agent, the more bulletproof way to make sure that this is a fully non-contingent offer that the buyer is sending over. Because if you agree to a non-contingent offer, you get it accepted, and then you deliver the TDS, the buyer could still have, or actually does have, a way to cancel this legally based on things that are stated in the TDS. We'll just wrap up this section here. I had a few extra ones, but we're already at time. So what should a seller know before accepting a non-contingent offer? If the offer is written as all cash or with no loan contingency, the seller should verify the buyer has sufficient funds for a down payment or entire purchase price before accepting the offer. If the offer is written without an appraisal contingency in a rapidly rising market, or even a market with increasing inventory and market times, which hopefully we will see here in the upcoming years, the property may not appraise, and the buyer, even if in breach, may be willing to cancel and risk a dispute with the seller. There is no guarantee a lender will loan, but fully written underwritten pre-approved buyer is as close as we can get in that scenario, but there's no guarantee an all-cash buyer will perform. The buyer may have a statutory right to cancel and be titled to return of any deposit. Again, if the seller provides a TDS after buyer submits offer. If the market practice is to deliver TDS after the offer is received, there may be little risk and even benefit in allowing a buyer an investigation contingency for the same time period that statutory cancellation right is in effect. So that's 5 days. Remember, 5 days after delivery of the TDS by deposit in mail, or 3 days if you delivered in person. Deposits are not automatically released to a seller, even if the buyer does not perform. A dispute over return of deposit may keep the seller's property off the market until that dispute is resolved through mediation or court. Um, Buyers who feel powerless in the purchase process may be more likely to become disgruntled after the sale, which could increase the possibility of a legal claim. Even if the buyer's claim is contractually baseless, the seller would still have to incur time, cost to defend any such claim. So there's a risk management guide for non-contingent offers in car if you want to check that out. I have a link to it here. This will get posted in the back office along with the copy of the recorded video. Um, so basically, if you are the listing agent and you want the buyer to submit a non-contingent offer, make it bulletproof by supplying all seller disclosures up front before the offer is made or before the offer is accepted. This will help ensure the seller has acted in good faith when asking the buyer to do this. This will help ensure the buyer has no right to cancel on investigations without being in breach of contract. This will help prevent EMD from being tied up in escrow and a dispute status, which is really frustrating for everyone. So we're a little over time today. My document here kind of keeps getting longer. This document will be in with the recording in the online office and the training and motivation page. So if you wanted to read through, I probably have another 4 or 5 scenarios in there if you want to, just check those out. But for sake of time, I'll go ahead and wrap up today. Thanks for coming in and participating today. I always like running through these. I think they're a good learning experience for everybody. If you ever want us to, present one, yeah, just throw it over and I'll stick it in here if you want to share something. But usually I kind of make notes, um, just throughout the months of things that would be good topics to cover. So that's about it for the day. Hope everybody has a great week. If you need anything, always give us a call, and we will talk to you later.